My current take is I have no idea what's happening. I think it's sort of the best way to say it. Anybody who claims to know what's going on, I don't think is being genuine. I always try to frame things in terms of conditions, right? Conditions that favor an accident. I always use the analogy that I don't know the exact mile marker that I might crash my car, but I know the conditions under which it's more likely to happen when it's raining.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Michael Gayed. Michael is, of course, a 5 times Dowman Founders Award winner, portfolio manager, and publisher of the League Lag Report. Michael, thanks so much for being on the show today.
I appreciate the invite.
I'd love to start off asking you, what's your current take on the global economy and financial markets?
My current take is I have no idea what's happening. I think it's sort of the best way to say it. Anybody who claims to know what's going on, I don't think is being genuine. I always try to frame things in terms of conditions, right? Conditions that favor an accident. I always use the analogy that I don't know the exact mile marker that I might crash my car, but I know the conditions under which it's more likely to happen when it's raining, obviously. So, when it's raining, you slow down entering a storm, and you might be wrong 9 out of 10 times because with hindsight, you would have never had a car accident, except for that one time where it saves your life, right? So if you have that sort of as a mindset to life, a mindset to markets, I think it's better than anything else. Now, my sense of the conditions are as follows. I think following that low that happened in April when I was wildly bullish on that day, saying you'd see the biggest interest rate turnaround for stocks in history, and happen to have gotten that right. You had this rip back. Everyone assumed the tariff tantrum dynamic was over. Everyone except bonds. Right? In other words, treasury yields have kept on rising, even though the hope was that deals would be made and some of the inflationary pressure from the tariff dynamic would ease, which tells me that something else is bothering the U.S. Treasury market, and it's very clear what that is in my mind. It's Japan, right? Given the way that yields have been spiking there, and obviously the spillover that you're seeing from the carnage in Japan's bond market to the U.S., given that Japan is the biggest holder of treasuries. So one thing is talk about the economy, another thing is talk about the markets and sort of the interplay of asset classes to each other, given the interconnectedness of financial disintermediation from that perspective. And I'd argue that this is sort of a long time coming, that Japan is a very real risk, remains a very real risk as a condition for a tail event, for some kind of extreme in stocks, which hasn't happened just yet. It momentarily happened August 3rd, August 5th, the reverse carry trade. But I think this is a much bigger story than people understand. I mean, what's going on with Japan's bond market is very, very serious. And it's not easily resolved, with them just hiking rates because their starting point of leverage is so high.
Could you dive into that further and just kind of unpack that, please?
Yeah, and so the whole thesis, going back really now 2 years almost, has been very simple. Because Japan has had negative to zero rates for the longest time because of their debt load and because of disinflation, deflation, what's happened is that Japan has been a source of leverage for the world, which is basically what the carry trade is. Right? People that borrow from Japan in yen, converted back to their dollars at essentially no interest expense. And as long as the yen is weak, you as the borrower like that, because it means when you pay back that loan, which has basically no interest expense, you're paying it back with cheaper yen, okay, which actually makes the debt burden less, while at the same time you're deploying that leverage from Japan into other assets that are making more money. So you've got this carry trade dynamic where you're using Japan as a source of borrowing to juice returns. Now, what happens if that reverses very suddenly? Well, that creates forced selling in the assets that people or institutions were using that borrowed yen in, and creates sort of a global margin call type of dynamic. Now, the whole carry trade dynamic has happened because rates are so low for Japan. Well, now Japan's got a very serious inflation problem relative to where rates are. And it's very clear the Bank of Japan is afraid to aggressively counter the inflationary pressure because I think they know how much leverage has been enabled by them for a decade plus on this carry trade dynamic. but they're going to have to do something at some point, and that's why I've said repeatedly, I think it's only a matter of time, even though I've been early in arguing that Japan will panic. Right? That panic is around rates, right? Around, which is, I think their bond market is sort of telling you is we're on the precipice of. The tariff dynamic obviously doesn't help, right? But I do think that this is sort of more of an issue than people realize, and it's been like a slow moving train wreck in a lot of ways. I've had a lot of people for years saying, "Oh, this doesn't matter. You're wrong. This is stupid." And now I see on X so many people literally outright copying the whole thesis as if it was their own, and people are now starting to understand and believe that yes, this is a big deal. And it doesn't get resolved by just 2 trading days in August. I mean, this is a dynamic which has been very profitable, still is profitable, by the way. In other words, the carry trade is still happening despite what's going on with yields, because the yield differential still is very high in terms of Japan's bond markets and every other yielding asset in the US, for example. So the real point here is that we're still in an environment where the conditions are raining. Doesn't mean that you go cash, doesn't mean that you go short. It just means you have to manage your risk and know that you could be surprised very negatively suddenly.
Now, you've mentioned about manipulation and things of that nature in the past. How do you see, powers outside of Japan and such, keeping the status quo going, so on and so forth?
Well, I think we have a president that doesn't like the status quo, right? That's very clearly sort of anti-status quo from that perspective. And as I've said, I think tariffs are a distraction from sort of the bigger risks that are happening kind of beneath the surface. But the status quo has gotten us to this point. And when I mean the status quo has gotten us to this point, what I'm talking about is the status quo means take on more debt. Just keep leveraging. By the way, that has permeated now to the retail market, because every time you see retail traders and investors go into the market, they're not going into Procter & Gamble and blue chip companies. They're going into the Mag 7, SPY, and then levered ETFs. Right? It's like, this is the opportunity set that all of these flows that are buying the dip are basically going into, that create not only emboldened sentiments, but even more re-leveraging. So every time you have a buy the dip, the leverage is higher because the conviction is higher by retail that they're going to be right again about buying the dip. And they are until they're not. It goes back to the driving analogy. In that case, it's the exact opposite. You're speeding up entering the storm. You're fine until the one time, right? So I think the status quo is due for a rude awakening, not just in the economy, but in terms of the way people think about what buying the dip should look like. It shouldn't necessarily look like levering into the dip. It should be being gradual and then getting confirmation, as opposed to just making this assumption that where they buy is the low, and let's go all in into as much leverage as possible.
Could you speak about how you're posturing yourself and perhaps various other things that you are keeping tabs on to stay abreast of what you've been espousing?
Yeah, I mean, look, I really don't read or pay attention to other people's research. I think for me at least, it clouds my mind a bit. I tend to just let sort of market prices dictate what's happening, and I follow a school of thought around intermarket analysis with a behavioral finance overlay on top of that. So keeping abreast is more about just sort of looking at different market movements and then getting a sense of the sentiment, right, as far as those movements taking place. I tend to be contrarian at heart, contrarian in nature. Now, I am biased in the sense that I like to see volatility because I have funds that are designed for that, as long as the volatility translates into widening credit spreads, which results in treasury prices rallying, yields dropping in a more classic risk-off phase, which we may be again on the verge of. As I keep saying, I think kind of early mid-June, we could be in one of those risk-off junctures. Maybe at the same time I happen to be launching a new fund, a deregulation ETF, which I'll make some noise about, an active thematic equity product. But I think keeping abreast of things doesn't come from looking at the CNBCs of the world. I think it's coming from looking at the drivers of why prices are doing what they're doing, and primarily looking at the asset classes which tend to have the most impact on the real system, which is interest rates.
And as it relates to assets and metals and things of that nature, could you share perhaps kind of unpack kind of your current thoughts and sentiment?
Yeah, I've talked. I've been early on. The gold is I'm not going to use the word fudged terminology I say on X, but this is after having been very bullish on gold since October 2023. I think on the precious metal side, I've made it very clear. I think silver is much better play than gold at this point, and I think gold has morphed from a risk-off asset to more of a speculative momentum trade one. I can see that from the sentiment. I can see that from the kinds of responses. And to be clear, I'm not bearish on gold from a long-term perspective because I think it's very possible that we are in a lost decade for stocks, which I know sounds silly when you look at where the S&P has been, but Russell 2000 small caps are halfway through a lost decade. I mean, they're basically at 2021 levels, many are at 2020 levels. So let's actually get a little bit more nuance in terms of saying what's the market, right? It's more than just the S&P market cap weighting. Many stocks haven't gone anywhere for a long time, long time, right? Deregulation may change that as a catalyst, but that's a whole different discussion. But I'm just saying it's like, if I'm right that we could be in this sort of lost decade dynamic, right, which would also then at some point apply to the S&P, then gold, very long term, still has a lot of attractiveness because it's a diversifier, non-correlated. But in the short term, I've made this point that if you have a margin call dynamic, that with a delay, gold would sell off on something called the disposition effect, which is the very well-known documented fact that people tend to sell their winners first before they sell their losers. And there aren't that many winners. Gold happens to be one of them now. Now, Bitcoin is as well, by the way, right? I could be very wrong on that, but if my original belief, which I still maintain, is the higher probability that the lows are not in, that we're still going to see lower lows, if I'm right on that, gold will sell off with that. I do believe that is most likely. I think that's going to be a buying opportunity from a long-term perspective, right? But I worry when I see so many people convinced of something that has gone straight up and only now are people paying attention to it.
And how about as it relates to fixed income? Could you kind of share your current take?
Yeah, and it's like I've been saying this on X. As the Fed needs to do an emergency rate hike and do it now, which sounds like a strange statement, but the Fed follows the 10-year. Like, I'm not saying that to be dramatic. I'm saying that based on facts. The Fed is always the laggard. The Fed responds to what the 10-year yield is doing. 10-year yield has been unrelentingly rising. Now, maybe it's going to come back in now because you're at sort of a point where it's looking more attractive relative to stocks, and now you've got some more uncertainty coming back, and credit spreads are very disconnected from economic uncertainty and from the message of small caps. A lot of my thesis revolves around that. But if the Fed is smart, the Fed should hike rates. Okay, I think every central bank should hike rates. If we lose control of yields, meaning this isn't 2022 again, if yields really keep rising because there's concerns around the credibility of the U.S. government paying off its debts, which sounds bizarre because we're the reserve currency, we have a money printer, then the only way to enforce credibility in the marketplace is to force discipline. To force discipline, the Fed has to increase the cost of capital, right? Because then that could be the wake-up call. Now, I know that has all kinds of implications on Trump versus Powell and this and that, but it's not Trump versus Powell. It's Trump versus the bond market. The bond market is saying you need to have more discipline, right? And I see a lot of people arguing that all this is a sign of stagflation. I don't believe stagflation works in a highly indebted economy where that's your starting point. You either have to force the deflationary shock or you have to force the hyperinflationary shock. There's no in between with this. And I think the deflationary shock is still much more likely.
Could you unpack that more?
Yeah, no, and it's funny. I was talking to some financial advisor the other day about this. Because a lot of people say, well, rates are going to keep on rising. But then I asked those people, okay, well, have you been seeing what's going on with robotics, with AI and sort of the idea that robotics and AI will replace employees? And they always say, yeah, sure. Right? And they can't wrap their heads around the exponential nature of how robotics in particular could really just change everything for the system fundamentally. I mean, I'm pretty sure that's disinflationary. I'm pretty sure that's outright deflationary. Right? I mean, tech has always been disinflationary, deflationary throughout history. And now you're talking about it impacting, as I saw with Musk, if he's right, the possibility you could literally order a robot to clean your dishes. Right? I mean, think about that for a second in terms of how little capital you'll need then to do things, because the biggest driver of capital spend is labor, right? So I don't buy the long-term thesis of yields just continuously rising. I do buy the thesis that credit risk rises, in which case those yields rise for a moment in time in a dislocation credit event, which again I've been wrong on, or early, depending upon your view on things. I think just early on it, but just like I've been on Japan and everyone's waking up to it. But no, I still think deflation is more in our future than inflation. And I know that's not a very popular opinion, but I look at all the demographic dynamics, the starting point of debt, the robotics, the AI. How can any of that ultimately be inflationary? I don't see it.
Yeah, and I know I've kind of touched a bit on like market manipulation and kind of a narrative and obviously headlines and political posturing rather, not being predicated on fundamentals and such. Can you kind of dive into that a little bit, or perhaps things you see coming down the grapevine, so to speak?
Yeah, and first of all, I've made this point a few times on other podcasts, but some people will say anybody that says the markets are manipulated is just a bad trader. It's like, no, you're in denial. The market is manipulated. Fact. It's manipulated by passive flows by 401ks that only go into S&P market cap weighting large cap passive proxies. That's manipulation. Sorry. When your default option on your 401k is just go into the market, and the market is basically market cap weighting, that's manipulation by a default option in terms of the way flows of income go into a retirement account. When you talk about the Federal Reserve has been manipulating the market since 1913. That's their job. The extent of the manipulation has only increased over time, but of course it's manipulation. You talk about algos manipulating and spoofing. Of course that's manipulated. Everything is manipulated. By the way, this is the only time I can imagine in my lifetime, and I don't know why people aren't more talking about this. Now the manipulation is happening and they're not even hiding it. It's just like outright transparent manipulation, which I don't think is good for the system and good for society and good for the way that capital markets work. But this is the world we're in because everyone's just now a degenerate gambler, including our president. And by the way, I'm not an anti-Trump guy by any means. I have a fun focus on deregulation coming out in June because I believe that that's a big theme going forward, right? And I believe it's actually a good theme. But let's be real here, right? As far as kind of where we're at as a in a moment in time as a country, as a people. So I believe in free markets. I don't believe in manipulation from that perspective by policymakers, but that's the world we live in. So we don't choose the cards we're dealt. We choose to play the game. But yes, it is manipulated. And from that perspective, I don't see how retail thinks that they can win against the powers that be that are maybe manipulating them to buy at the wrong time.
Now, as it relates to that new product that you have coming up, you mentioned that it's on the deregulation theme and expected to benefit mid and small caps, as obviously opposed to large caps. And you see it as a multi-year bull cycle trigger for sectors long overshadowed by the S&P. Can you dive into that a bit more?
Yeah, and also part of the thesis is that in deregulation, regulated markets tend to have less volatility. Deregulated markets, which are more free market oriented, tend to have more volatility. If you don't believe me, just look at Bitcoin. I mean, that's the freest market of all, right? Which has no manipulation from that. There's degrees of manipulation on that from bot activity and things like that. But just intellectually speaking, right? If you have more deregulation, what happens? You end up having more volatile markets. I don't mind that. More opportunities, right? To position against the crowd and counter and fade. When you have deregulation, you tend to have more opportunity for faster innovation, for more M&A, for less barriers to entry, which should mean more competitors, and which, by the way, should also result in mid and small cap companies maybe having a chance to counter higher rates, because now that compliance burden is not increasing their SG&A expense side of things, right? Which in turn makes margin profitability higher potentially, which benefits them in terms of their ability to pay higher interest expense. So I think, and I think it's a theme that can go beyond Trump's 4 years. Right? In general, I think there's a real case to be made that free markets tend to have better outperformance, right? Because that's when real efficiency can be had, and it's what separates the real solid companies from everybody else that's just living because of regulation. So there's a lot of opportunity there in the space. The fund, which again I'll make a lot of noise about as it's live in early June, ticker is going to be FMKT, which stands for free markets. Very different than my existing tactical rotation funds, which are asset class and volatility specific. This is an active thematic type of idea. But I think the implications of it, even beyond my own talking about my own book on deregulation, is that this could be, if I'm right, as a theme, something that sparks that relative momentum trade finally into mid caps and small caps out of this large cap tech only kind of world we've been in, which I'd argue is good for everyone. It's a lot easier to beat the S&P when it's not the only game in town.
Yeah, I remember you mentioning on other shows how important the small and mid cap space is and how it's often overlooked and such. Are there perhaps other things that you feel don't receive enough attention or perhaps that keep you up at night?
Well, if I'm day 3 in my fast, I tend to be kept up at night because that's when I can't sleep. Typically around day 3 is when it's harder to sleep. Look, I mean, why did Trump suddenly try to get the market to rally? Or, in that April 8th or whatever the date was, move. Because you were, I think, at that point, at what I had posted a couple days before, I said we're at the Hank Paulson moment. And what I was referring to is when Hank Paulson, as I recall, basically was like on his knees to Pelosi saying you got to pass, I think it was TARP in 08, because the system was on the verge of collapsing. That week, which was the low, I think was far more dangerous than people realized, because you were going to have massive margin calls happening all at once because the speed of the decline was so sharp and the starting leverage was so high. And as I keep saying, the end of the world is the bull case. The policymakers were not stupid, saw that was suddenly a systemic risk and said, we got to do something to try to counter it. So they floated the balloon out around pausing tariffs Monday. They walked it back because they were trying to see what the market's reaction was. They saved that ammunition for the Wednesday, and then that sparked the rally. What keeps me up is that you could still have that dynamic happen all over again, very suddenly out of nowhere. And it could be even worse because there's been now even more leverage, right, into this. While Trump is trying to do this tariff balancing game against Japan, which is obviously in some very serious bond market trouble. And so the concern is that you wake up overnight and suddenly it's like an 87 crash. Now, I have used that line many times before because I still believe that's an endpoint. They'll crash stocks to save bonds, the flight to safety to push yields lower because they have to save bonds because that's what the whole damn system is predicated on. But the concern is that I could be right, and this is more me talking selfishly, and my own strategies get it wrong because no matter if the endpoint is right, I always keep saying path matters more than prediction. I could be right about all this stuff, but I don't know when. Right? And the path to get there is all that matters when you're actually managing portfolios, right? So that's what makes me nervous that I could be right and still lose money on the trade. Which, by the way, is what every real trader should always be considering. Right? It's like this is the only domain in life where you can be right in your thesis and lose money, or wrong in your thesis and make money. And that's the challenge of being a long-term allocator. I hope that makes sense, but that's sort of my own personal concern.
And is there anything else that you'd like to dispense to the audience, out there, any other trends?
No, I think that's the main one. The bull case is very simple. If I'm right about deregulation, it's a very long-term theme, the deregulation arguments, right? It's fundamental. I think plays out over years. But, if Trump is smart, he needs to switch the narrative from tariffs to something else. He's been doing that a little bit with the big, beautiful tax bill, but that's maybe actually being seen as a negative because of the implication on yields. So deregulation, I think, is the next major narrative. So I'm hoping that I can launch my FMKT ETF with my partners around that fund at the right time from a keyword perspective. But that would be bullish. Like if you're going to make a bull case, the bull case is that, and small caps, mid caps finally have their cycle. The bear case is very simple. The most disconnected from reality asset class in the entire world right now is junk debt. Junk debt has completely recovered off of that low from the panic of the tariffs. It's acting as if there is no default risk, while small caps still are saying there's default risk, which has been the fundamental disconnect for me for the last 2 years, that I believe Japan is the catalyst to sort of counter, right, to resync those messages. And which way it plays out, I have no idea. I wouldn't mind either scenario. I just don't want to be in a world anymore where it's just about passive S&P.
Well, Michael, I appreciate you carving out the time to obviously be on the show today. It's been an honor, and looking forward to obviously having you on down the road.
I appreciate it.
Thank you. Take care.
Cheers.
quick ask. Over half of you who watch the show regularly haven't yet subscribed. If you've enjoyed the show, you're finding value in it, subscribing is really the best way to support the channel. It's, of course, free. It literally takes 2 seconds, and it lets the algorithm know that this content matters. And, of course, my commitment to you is going to be that I'm going to continue to bring on great guests, refine those questions. And of course, I'm always receptive to your feedback. If there's certain people that you'd like to have on, or certain questions, or this, that, and the other that you'd like to have as part of the show going forward, things of that nature, please let me know. I'm pretty easy to access. Anyhow, that's my commitment to you. If you can subscribe, that would mean a lot. Thanks.